A question I often get asked is, how do I know if my backtest is accurate? Is the backtest actually going to match forward trading performance? In this video, we're going to talk about a few factors which make it likely that your backtest is going to match your live performance. And if these factors are not being met, what can you do to mitigate it so that you're getting the best results out of your backtest as possible and you know what to expect from your actual live trading? The first factor which determines whether or not a live trading results are going to match a backtest is hold time. Pretty much, the longer you hold a position for, the less it's going to be dependent on conditions of the market, conditions of your broker, and the more likely that your backtest is going to match live trading. Think about it logically. If you hold a trade for literally the entire day, you can have a 3% move, a 5% move. And if you hold for such a long period of time, and you have a big profit target and a big stop loss, you're going to be far less impacted by little wicks which might have tapped your take profit or stop loss. You're going to be less impacted by having the absolute perfect entry, and therefore having this more swing style approach is going to not necessarily be overly impacted by live market conditions. And because of this style, these longer hold periods are going to make your backtest and your live trading match exceptionally well. Even if you have a not very good backtest engine, if you're holding for 15 hours, 16 hours, 17 hours, you don't really have to be super concerned about all the market costs, the spreads, the commissions, the latency, which a bad backtest engine might not pick up. Just because if you're holding for long enough, many of those factors represent an increasingly small percentage of the total return or the total performance, and it's not really a big deal if you just hold long enough. So the number one factor here would be hold time. The longer you hold a position for, the more likely your backtest and your live trading will match perfectly. The second big factor here is trade frequency. So if you're taking hundreds of trades in a backtest, chances are you're going to miss a few of them when you actually run this live. And this is very different than taking one or two trades, where essentially if something is triggered less frequently and the trigger is more robust, most likely your backtest and your live results will match. The second, like a 2B, another factor is depending on the trigger used, if it's a very robust type of trigger, most likely it will appear in both your backtest and your live trading results. The perfect example here would be a time-based trigger. If you say, hey, every day at 1 a.m., we're going to buy. Most likely, if it's a time-based trigger, which is coming off of a candlestick, for instance, the 1 a.m. candle, that's going to show up in both your backtest and your live trading. However, if you have a less robust trigger, like for instance a candle size, where you're looking for a candle to be exactly $2.13, there you're significantly more susceptible to price feed differences. And that susceptibility is going to probably create some sort of variance between your live trading and your backtest. So the first one is really hold time, the second one is really trade frequency, and the third factor here is really what is your trigger. If it's a robust time-based trigger, or if it's a very strong trigger, then most likely you're going to have a pretty comparable matching. Another factor here would be data quality. So especially when you start to run tests on shorter hold periods, if you have bad data quality, quite often your backtesting engine is going to approximate what you're going to be seeing. So if you look here, for instance, at a backtest, here we can see we have 100% data quality on this particular account. If this number is 5% or 10%, it means that your engine did not have enough ticks in order to run an accurate backtest. And in doing so, it probably had to go and use 1 minute open, high, low, close data. And by doing that, it likely also did not take into account spreads properly. So your backtest will probably look a lot better than what would actually look in the live market, simply because you're not factoring in your spread cost, which can have a pretty big impact depending on the style of trading strategy being used. And finally here, we're going to look at the use of, and kind of tying on that, every tick based on real ticks based on 1 minute open, high, low, close. So depending on your broker, you can test with both every tick, so tick data, and you can test with 1 minute open, high, low, close. And with certain types of strategies, and here I was playing around with one of our bots, you can see that there would be a pretty significant difference between the two. And obviously, if you do this with more of a swing style system, it won't make nearly as much of a difference. But if you start to do this with more scalpy style systems, it can make a pretty big difference. So really, those are the main things. if somebody comes to me and says like, hey, is this going to match, is live trading going to match my back test? You really have to kind of go through that checklist. And the more of the favorable factors you have in your favor, so doesn't trade too often, bigger targets, we have good data quality, we have a very robust trigger, we're using every tick based on real ticks, we have 100% data quality. If you stack all of those, most likely your back test is going to be near identical with 99% accuracy to your live trading. Conversely, if you kind of have everything else against you and you have like a ton of trades, you're holding for an extremely short period of time, you're scalping, that system could very well be profitable, but you're much less likely to actually trust a back test. Because in a system like that, where there's a huge amount of impact from the market, you probably want to definitely forward test it in order to get a bit more information. So really it comes down to those factors. There's a few traits which make a strategy more likely to have extremely similar results across back testing and live. And if that's the case, you are able to perhaps have a shorter forward testing period. But some strategies which are maybe high frequency, arbitrage, super quick, which are trading for like 2-3 seconds, those you really have to be careful because a lot of those factors are not in your favor. So guys, next time you run a back test or you run any sort of new strategy evaluation, remember hold time, frequency, data quality, and every tick based on real ticks and the robustness of the trigger. If you get all of those down, you should be good to go. If not, it could still be a really good strategy, just be a little bit careful. So guys, hope you enjoyed the video. I'll see you in the next one.